Good evening, everybody. Thank you for coming to tonight's business awareness revision session. Tonight we're moving on to task 2 of the business awareness mock 1. This is another task that really is quite substantial. So again, we'll be breaking this into 2. We'll be looking at the first half of it tonight, and then next week we'll look at the rest of the task. Now, before we get into the details of the slides I've prepared, just the first section is going to be about different types of business. So let's just have a bit of a think about different types of business. And you'll be excited to know I'm going to do some more of my wonderful artwork for those of you who've seen it before. I've missed this a long time since I was 5 and could draw stickmen all day for a living. Okay. The simplest kind of business we can possibly have, and how most businesses probably in the world actually started. What do we call it? Simplest business you can have in the chat box, anyone? Yeah, it's sole trader. Absolutely. Sole trader. It's one man on his own. Easy life. No one to argue with, no one to fall out with. His accounts are nice, and let's think of what's good. What's good? Simple. If he wants to make a decision, he makes a decision. No negotiation with anybody, colleagues or anything. His accounts are straightforward. If it's a very small business, he can just report how much he's made, the revenue. He doesn't have to give them full accounts or anything. Downside of being a sole trader is, of course, it's risky. If he's a builder and he drops a brick on a passer's-by's head and he hasn't got adequate insurance, he could lose everything that he's worked for. He'd lose his house. His own capital is at risk. In the eyes of the law, it's not how we do the accounts. In the eyes of the law, the person and the business are the same. Another downside of being a sole trader is, what if he wants to go on holiday? He's all set to go on holiday, and his best customer rings him 10 minutes before he's leaving home. I need this job doing. If he's a plumber, maybe my boiler's leaking. So what can he do? He can either lose his holiday or lose his customer. You know, lots of pressure, lots of pressure. And for his holiday, no holiday pay. If he's off sick, there's no sick pay. So simplicity in lots of ways, but there's a few downsides being sole trader. Okay. So the next most complicated type of business is, of course, where we have lots of people working together, which is a partnership. And in many respects, yeah, thank you, Kachushka. Yeah, partnership, the pros and the cons, the advantages, disadvantages are very similar. Accounts wise, a bit more complicated. And we'll look at the details of what the complications are. It's a bit more complicated. But from the 3 items that we've listed already at the top, what's advantage number 1 of a partnership? A sole trader. Think about that aeroplane that you're going to be catching in 3 hours' time when you get to the airport. You've got holiday cover. Next advantage If you're going to be a sole trader, you've got to do everything. You've got to be able to do whatever job comes up, whether it's straightforward, complex, it's all down to you. If you've got partners, you can specialize. You maybe have, if you're offering business services, you might have one partner who's very good at producing little bits of software that you can sell to your clients. Somebody else might be a brilliant salesman. You could be the most able, industrious, capable person in the world at providing a service, but if you're really not good at selling it, you won't do as well as a company that's a bit rubbish but has got really good salespeople. So, you can have specialized skills, shall we say. The other thing that partners can bring in is resources. Not only their intellectual personal resources, they might bring some money in. More people can afford more machineries, generally. But in many respects the same, they're still just as risky. So when partners have got to a certain size and they're thinking, you know what, our business is doing really well. If it goes bang in a big way, we've got a lot to lose. What might they do? They may form a company. Not all companies have got sloping roofs or chimneys, but what they will do is form a company. And the big advantage of a company is it has its own separate existence. Now, if Charlie the bricklayer is building a wall and he drops a brick on someone's head, the company can get sued, but not Charlie the bricklayer. This means that the partners can only lose, they're not partners anymore, they can only lose the money they have invested to start the business. So they have limited liability. So they have become shareholders. And in a small business, they may well still be involved in running the business. And if they are involved in running the business, it means they are playing two parts in our little scenario, because the business is run by people called directors, and the job of the shareholders is to appoint the directors. But what they may well do, the partners who are now the shareholders who own this business, they may well appoint themselves as directors. So this is a common cause for confusion. If ever you go and work for a relatively small business, you'll have somebody sitting in a big office at the end who calls himself the managing director, but he also owns the business. So he's actually doing two jobs. As a shareholder, he has employed himself as managing director. And the job of the directors, they are within the business, they run the business. They direct. To direct is another word for steer, and their job is to work for the benefit of the shareholders. So the same people, that's not difficult to do. In a bigger business, the shareholders may well need to keep an eye on the directors to be sure that they are acting in their best interest and not just paying themselves huge bonuses. And the shareholders don't have direct control. They don't make day-to-day decisions. But if the shareholders at the annual meeting are not happy with the directors, they can vote them out and put other people in. In bigger organizations, there may be many shareholders. You can be talking even in millions of a really big organization. I think I got about £50 worth of shares in Lloyd's Bank that I inherited from my late mum a few years back. They don't ask me to join in board meetings. They do send me a form sometimes where I can offer to give my vote to someone else. But there are many thousands of people with much bigger holdings than my humble 50 quid. So the directors can vote, the shareholders vote the directors in or out. What this means is, now every share, each share that a person has a vote. Each share has one vote. So that does mean that if you own more than half, if you as an individual own more than half of the shares in a business, you can outvote all of the other shareholders, and that is referred to, if you've got more than 50% of those, as a controlling interest. And these are terms that you'll meet a lot in the Level 4 financial statements unit, but this is how shares work. If you own shares, you have voting rights. If you own more than half the shares, then all of the others put together, even if there's 1,000 of them with one share each, 1,000 shares, if you've got 1,001 shares of your own, you've got more than all the rest. You are in control. So the downside of companies, of course, are that actually one downside of partnerships is more negotiation needed. You can't just say, I'm doing this. You've got to agree with your partners. In a business, much more negotiation amongst the various people. The bigger the company, the more difficult it becomes to make a decision, and the longer it takes. Accounts are more complex. There is a perception in the powers that be that limited companies, because of the limited liability, run on other people's money, and therefore all the rules of accounting are all designed to make sure that those companies are run honestly and efficiently, and directors are very restricted in how they must present their accounts, so that it's very difficult for directors to present accounts that look any different to anybody else's, so you can get a fair comparison. It's very difficult for them to make things look the way they would like, to justify bonuses or to persuade the bank to lend them money, or even to minimize how much tax they pay. They're very, very restricted in presentation. So that's the story from starting our business. Why I was thinking, why do we, why give up all that control and have partners? Well, you might want holiday. Why give up the simple life of partners and form a limited company? Well, it's safer. It's safer because of limited liability. The other thing that a limited company does have over sole trade or even partners is credibility. When we're spending a lot of money on an item, if it's from a limited company that's, got a name and it looks the part and it's got all people in its offices, you're perhaps going to be a bit happier spending a lot of money with a proper company than if it just happened to be a bunch of friends who are producing a similar product, even if it's the same factory. Businesses, limited liability has credibility, which is very useful when it comes to opening credit accounts and borrowing money from suppliers. They look the part. So that's kind of a whistle-stop tour of why we go to all the trouble of forming more complex businesses. So let's look at it. Now we'll look at the task brief and look at it in a little more detail in terms of what we're going to meet in the exam. So task 2 deals with analysing the external environment. This really is how the business relates to the environment. We will meet elements of company legislation. And as we've just said, there's a difference between who owns the business. Whoops. Supposed to be a highlight. Who owns the business and who runs the business. But as we've said, in a small business, a small company, there can be an overlap there. What do shareholders do? Yes, first and foremost, they put money in because no business can all operate without money. You can't have premises, you can't have machinery, you can't employ staff if you don't have any money. And as we've said, their job is to vote, and the typical decisions that they make will be appointing directors, it does this. They vote on appointing directors. The other thing may well be the decision to issue more shares. And that may be something that is, when a company is set up, there are various terms and conditions. A company has a thing called articles, and it has a memorandum. And the gist of which is those documents say what the company is there for, what it's allowed to do, and also how many shares it can issue. And often to get things like that changed, then the shareholders have to agree to that. I mentioned that control of a company is based on how many of the shares you own. Now, let's say there were 2,000 shares in issue, and you own 1,001 of them. That's only 999 owned by other people. If the company wanted to raise money, the directors say, we need to buy some new machinery, we want to issue another 500 shares. Now you've got a problem that if those 500 shares are sold, if you don't buy them, you've no longer got the minority holding. So you'd need to make sure that you bought enough of those. Now you might not be happy about that. So whether to issue more shares is a decision made at meetings with shareholders. I do recall frequently we used to read in our local paper that if our local football club, it's not a big glamorous club, needed to buy a player half the time, they would vote on having a share issue to see if they could afford to buy a player. And these are the days when a player was about £5,000, so it was a while back. So shareholders are entitled to be kept informed by the directors, because obviously if their money is tied up in the business, they're entitled to be told how it's doing. And again, level 4, when we get on to preparing company accounts, they must be prepared in a way that they look the same every time in structure and layout, so that people like the shareholders, who probably are not accountants, can actually compare them with the last year and make sense of them. They can require the directors to call a meeting. You have normally you have an annual general meeting, but if something comes up, there can be an extraordinary general meeting. Those are the two terms that you may well meet. They can attend meetings or send a proxy. This is the form I get for my 50 quid Lloyd shares that says you can sign here if you want and appoint this person to vote on your behalf. They can vote depending on the class of share. You'll see two terms that you will meet. There are ordinary shares. There are preference shares. Now, the differences being, if the company makes a profit, the way the shareholders are recorded for their investment is a dividend is paid. But it's at the discretion of the directors. It's only if there's profit available. So that doesn't automatically mean that if the company makes £500,000 profit, £500,000 will be shared out amongst the owners, because it may well be that that £500,000 chunk of that might be needed to renew some machinery, to buy some new vehicles. And of course, already when you've looked at preparing financial account, or when you prepare financial accounts, there is a difference between making a profit and having cash in the bank. Because if you sell, for example, to a customer on credit, you've made the profit, but you haven't actually got the money until he pays. So there's a big difference between cash and profit. So ordinary shares get a dividend if there is profit available, but they do get to vote. Ordinary shares almost always have voting rights. The other type of share is a preference share, and a preference shareholder gets a percentage dividend guaranteed. Nope, that's not right, is it? I got this wrong in a crossword the other day. That was right, wasn't it? Yes, guaranteed, UA. So, in exchange for getting a percentage dividend, usually a preference shareholder will not have voting rights. Not always. There are occasions when preference shares are specified with voting rights. As a general rule, ordinary shares vote, preference shares don't. The ordinary shareholders are perceived as being the people who are taking the risk. Their money's put in for no guarantee of any return. Whereas the preference shareholders are really perceived more as people who are lending money to the business and expecting something back. Just to clarify on the guaranteed, if business is in dire straits and has absolutely no money to pay a preference dividend, it can be deferred, but every penny of the preference dividend must be paid up to date before they are allowed to distribute 1 penny to the ordinary shareholders. Appoint and remove directors, we've said that is how you control the business. If you've got the majority shareholding, you can put people in charge who will do your bidding, and you can get rid of them if they don't. Likewise, the job of auditors is to protect the interest of the shareholders. They do that in a very simple way. The auditors are simply there to guarantee that accounts produced and presented by the directors, the auditors will check that they show a true and fair view. Therefore, whether the news in them is good or bad, the auditor's job is to check and confirm they have been prepared the way they should be in conjunction with legislation and accounting rules and regulations, as something else that you'll cover in the Level 4 financial statements unit. So the auditors are appointed by the shareholders, and their job is to confirm that the accounts are true and fair. So if the directors are trying to pull the wool over anybody's eyes, the auditors hopefully will detect that in their investigation. They don't check every transaction. They will check samples. They'll look at the procedures the company follows. They'll walk through some transactions, and at the end of it, they will conclude that either the accounts can be trusted or not. They're not there to find criminal activity like fraud, but it's hoped that if they do their job properly, then if there was something wrong with the accounts, they would detect that. So that's who owns a business, what shareholders do. Next one to look at is what the directors do. So the directors, 2 types of director: executive, they're the directors as we know them. Their job is to run the company. They usually, notice they are employees and they're paid a salary. But a company may well have, a bigger organization especially, non-executive directors, and they are there to run an experienced eye over what the company is doing. They're a bit like Jiminy Cricket, conscience on the shoulder. They're there to really be a little bit of a restraining hand on the directors who are there all the time running the business. So generally there'll be people who are very experienced, possibly they, often they might be people who've retired from their sort of full-time day-to-day jobs, but they have a retainer to keep an eye and see fair play in the running of the business. What must directors do? They must act within their powers. We mentioned already that the company articles of association and the memorandum say what the company is for. So if your company is set up to provide building services, and that's what your articles of association say your company is for, the directors can't suddenly on a whim say, oh, let's start selling speedboats because we reckon we could do well. They may well go to the shareholders at a meeting and ask for that to be changed, and the company's articles to incorporate providing building services and selling speedboats, but they are restricted by what they're to do. Likewise, the issue of shares, they can't go issuing more shares willy-nilly. Their powers are limited. They must promote the success of the company. So again, that means they should be looking for the company to have long-term benefits. They should be looking to build the reputation of the business. What they're not there for is to make a good salary for a short time, make a few quid, pay themselves whacking rate bonuses and then clear off. So they are required, duty bound, to promote the success of the company. And although directors are employees, if directors are felt to have been running a company other than ethically, then they can be brought to book for that. They appear to have to, looks like something's got duplicated there, to exercise independent judgment. Yes, it means they've got to think about what they do. Directors, there may well not be a book of notes, a book of rules and guidance notes for every situation that can arise. So directors should be, highly capable people, highly experienced people, who can deal with situations that arise. To avoid conflicts of interest, yes, we've talked about conflicts of interest briefly already when talking of ethics. What about the man who, we said a building company, didn't we? Okay. Building companies need to buy bricks, they need to buy wood, they need to employ tradesmen. A guy who is a director of a building company might have to think long and hard about whether he should employ his brother-in-law as maybe a contractor. Is he picking him because he's the best person for the job, or is he picking him to get an easy life at home with his wife, who's saying, don't forget our Charlie, Charlie's not got much on at the minute. So conflict of interest is, he's got to be acting in the best interest of the business, not in the best interest of his domestic harmony. If a supplier says, Mr. Director, we were thinking that it would help your thought processes when deciding whether to buy from us or the people up the road if you were to have a few days peace and quiet reflection time in our holiday facility in the Maldives. We'd be delighted to give you a couple of plane tickets so you can think it through carefully. Now, is he going to favour that supplier because he fancies a few days in the Maldives, is that going to affect his judgment? Which feeds into not to accept benefits from third parties that could give rise to a conflict of interest. The key word always, whenever we're talking benefits from third parties, is reasonable. There are plenty of organizations that will send their best clients a bottle of wine, you know, as a thank you for their business. Oh, conversely, a lot of happy clients may well go to their service providers and say, here's a bottle of wine, you know, for Christmas, and thank you for doing a good job of my accounts, for example. The key word is reasonable. What you're looking for, will it influence somebody's thought processes? Or, you know, I don't think many people will be massively influenced by a bottle of wine at Christmas. I might be. Okay. Company formation. Yes, when a company is started, I've mentioned already, we have the company's articles and the memorandum. You'd be relieved to know you'll not be expected to know all the clauses that are in those. They can run into pages and pages and pages. But you can't just sort of stick an advert in the paper one day and say, hey, everybody, I've got a company. You've got to advise the registrar of companies. And you have to, on registration, you'll be given a certificate of incorporation that proves you are allowed to advertise yourself as a limited liability company. And thereafter, you will have to be supervised by Companies House, who will expect a copy of your accounts every year. Whereas as a sole trader or partner, your only reporting is to the Inland Revenue. First time I got it wrong. His Majesty's Revenue and Customs. You sole trader partner has to report to, but with a limited company, Companies House takes over the supervision, and your accounts must be in a very strict format. They must look the same as everyone else's. They must be reported. Accounting records must be kept. Confirmation statement, I'm not sure what that refers to. Thinking this is all part of what you get back from Companies House. So the big thing to remember is that a shareholder is not a director, he might be, but can be. So keep that distinction clear in your mind, that by and large, when we talk shareholders, directors, they are very different people. Okay, so let's move on. Partnerships we talked about, and notice we've used the term unlimited liability. This is a traditional ordinary partnership. Now, I mentioned that one of the slight issues with forming a partnership as against being a sole trader is that there's a need for negotiation. You can't just decide something and do it. And any negotiation gives rise to potential for conflict. Now, the law has anticipated this. It anticipated it 130 years ago in 1890, not 1980, which is a very popular answer I've seen before to assignments. If there is no documentation in place to govern your partnership, then the Partnership Act of 1890 takes charge. And what that says is all partners get an equal share of profits. It says there are no salaries. Even if one person works 40 hours and another works 4, there's no salaries. Even if one person invests a lot of capital and others don't, there is no interest payable, and that's it. So basically, if you don't have any agreement to the contrary, that's what happens. What usually happens is the partners will form an agreement. And the idea of the partnership agreement is it prevents arguments. It tries to anticipate all the things that they could fall out about, puts rules in place. So if there's any question, it's in the agreement. So how profits and losses will be shared, including salaries, commissions. One person might work a lot of hours in return for a guaranteed certain salary, another might not. Interest on capital. Interest on drawings, partners are encouraged not to draw money out early. And it may be that partners who draw money out earlier during the year, because they've got to live, are penalised, whereas another partner who leaves their earnings in the business and draws it out at the end of the year is rewarded. So these are all to be agreed. And finally, the profit share ratio. With partnership accounts, anybody who's done the financial unit already, we start with the profit from the business. We then adjust it for any salaries, they come out first, any interest payable, and then what's left, the remainder, is what we share. Things like how will decisions be made will be in the agreement. Will it simply be a majority vote? Does it have to be a unanimous vote? That can be tricky if you've got half a dozen partners. A unanimous vote, you may well never make a decision. Again, new partners, do all partners need to agree? That's more likely to be unanimous, or could it just be a majority? How much does each person contribute? And what if there is a problem? Can we have a situation where the rest of the partners can all gang together and throw somebody out? So these are all things that we've tried to anticipate where the problems and the falling out and the arguments are going to come from. Now, something else that you will meet or have met in the financial accounting unit, partnership goodwill. If two people spend 10 years building up a business from scratch, and they've got a big bank of customers, they've got a load of orders, they've got really good products, good reputation, they may not have a lot of measurable assets in terms of build. They maybe rent their buildings, they might have a bit of machinery, they may not have much in the way of measured assets, but that business is worth a lot more to them than just the value of the assets. So if they wish to admit another person to it, they're not going to let them just walk in and take a share of the profits that are now being earned. So what happens is a person who comes in will buy into the business. You may have heard that expression. They'll buy into the business. What happens is they will contribute a certain amount of money, and the mechanism we use, rather than give them all of that as capital, we introduce goodwill, which rewards the existing partners and is paid for by new partners. And again, we're not going to the mechanics, but this is what goodwill is. It's the difference between what you can see in measurable assets and actually, we've put sale price of business, we're not necessarily selling the business, but the actual value that we put on the business. And that enables a new partner to pay a fair share for the hard work that over a period of years the existing partners have put in. Likewise, the opposite side of the same coin, if somebody retires, goodwill is used to reward that person for what they have contributed. And it's the exact opposite. In that case, money goes to that old partner in return for the work that they've done. This is really a bit of a whistle-stop tour. The mechanics of all this you will deal with in the financial unit. So we've only got a short question this time. Most of the questions in our mock are to do with other areas that arise in task 2. And we're asked which 2 statements are true. So thinking back to the pros and cons of being a sole trader, does a sole trader have separate legal status from the business? Does a sole trader need a partnership agreement as a sole trader? Well, I think that one we can pretty well discount because the sole trader hasn't got any partners. A sole trader does not have limited liability. And finally, preparation of financial statements is the responsibility of the sole trader. Well, as we've said, the big risk for a sole trader is indeed that he has personal liability. So indeed, he does not have limited liability. We've said he doesn't need a partnership agreement. We scratched that. Does he have separate legal status? No, he doesn't. And indeed, he is responsible for everything in the business. He may well employ an accountant. The keyword responsibility. He can delegate the work, so he can employ an accountant to come in and produce his figures, but he cannot delegate the responsibility. So if he gives his accountant inaccurate figures to work from, then that is his responsibility still. And that concludes tonight's session. Thank you again for attending. I hope that's been useful. I'll now stop the recording.